All right, welcome back, everybody, to Wook Capital Management's 38th edition of our weekly Wook and Review broadcast. We're going to cover some major market news impacting different uh, industries, companies, geographies, et cetera, et cetera. So I am Wook Capital Management Managing Director Rod Alsman. If you are following along with the live stream, we've got the audio and video available in our Wook Discord. The audio only is available here on Spaces. Of course, if you're tuning into the recording, you're getting both. If you are following along, yeah, JP, if you could pin the latest thread from today to the channel, and I'm sharing the latest newsletter on the screen, which is the contents of that thread. So yeah, let me go through the prepared material. First off, just need to read this disclosure so that we don't get sued. Wook Capital Management, Inc. and its employees solely provide investment advisory services to family clients and do not provide investment advisory services to the general public. Furthermore, investments are highly speculative in nature and involve substantial risk of loss. We encourage investors to obtain advice from your professional investment advisor and to make independent investigations before acting on information that we publish. We cannot assure you that the information is accurate or complete. We do not in any way warrant or guarantee the success of any actions you take in reliance on our statements or recommendations. Past performance is not necessarily indicative of future results. All investment decisions of an individual remain the specific responsibility of that individual. Okay, so highlighted a few things in this week's newsletter talking about kind of what's going on with home builders and how resilient that whole space and the stocks within it have been. The kind of threat or risk of some AI regulation potentially coming down the pike. And then a little bit of more of a discussion on freight rates and freight markets. So we got the Fed chair, Jerome Powell, testified to Congress this week, reiterated the message that came out of last week's FOM, or whatever week it was, losing track of time here, FOMC meeting, where Powell, basically said we have a long way to go still with inflation. Core and PCE, personal consumption expenditures, remains higher than the Fed would like it to be. While it's been slowly declining, it's still far above their target. And while they paused at the last meeting or opted not to raise rates, and the message from Powell was consistent with, I think, the messaging from the SEPs from the committee that they do expect more interest rate hikes in order to control inflation, though they will be data dependent and they're not set on any particular path. So we will be back on Tuesday night at 8 p.m. with Think Twice by Michael Mauboussin. It will be it's our 7th book club. It's the 6th of this year. So we'll look forward to that discussion Tuesday night, kind of highlighting common pitfalls and cognitive biases that can lead to errors, providing strategies for investors to avoid those errors and to really think deeply and try to challenge preconceived notions and initial intuitions when they're making decisions. So I think it'll be a good discussion. Looking forward to it. Okay, so first newsletter topic is Tesla. We can't stop talking about everyone's favorite, insert adjective here, stock, right? Depending on who you ask, some people, myself, might call it a car company. Other people might call it an AI company. Still more might call it an autonomous vehicle company. While it hasn't generated any revenue from those last two adjectives, it certainly has generated a lot of purchasing from retail investors. Vandatrack, who we've referred to a few times here, who provides different market data for what they deem retail investor trading and investing activity. You can see the graphic from the newsletter show, which, yeah, I'm gonna have to hang on. JP, I don't see it pinned, so let me try to find this link so people can follow along. Okay. Now it's pinned. So, yeah, the stock from the VanderTrack data has seen several $100 million of net retail inflows over the last couple of weeks. And you can really see since NVIDIA came out with earnings a month or so ago and had that really bullish take on what the demand that they're seeing for their newest generations of chips. Just huge inflows into both Tesla and this broader AI basket, which beyond NVIDIA includes three other big tech companies, Microsoft, Alphabet, and Amazon, as well as the one I like to disparage, C3.ai. So, Adam Jonas put out a note, quote, "We think the market wants to believe Tesla is an AI name first and auto company second." Look, I won't try to make too much sense of it because, as we all know, short-term price drives the narrative more than anything. But when I step back and think about Tesla, which in my personal account I have a short on, and I was able to monetize a weekly call that I wrote that I have rolled to next week. So I'm short 100 shares and willing to take on more of a short position, just because the math really doesn't make any sense at all. The underlying fundamentals for the company remain challenged in this landscape. So I'll just take a look at kind of the analyst estimate revision trends, and depending on which, if you want to look all the way at the top line at sales, and we can look at the last 6 months, you can see analysts have been marking down their sales estimates for both this year as well as for out years. If we look at earnings all the way to the bottom line, we can see analysts have meaningfully been marking down their estimates for Tesla EPS and EPS growth. So when we look at these silly things called fundamentals, Tesla's trading at a 42 times 2025 estimated earnings. So while the company likes to convey a message that it's super high growth and it's going to continue very high growth for a long time, the analysts, at least on the sell side, if you look at the EPS estimates, by the time we get to 2026, 7, 8, 9, we're talking about single-digit earnings growth penciled in. So the multiple never really compresses too much because earnings aren't really growing too much, at least from their estimates. Which, again, depending who you ask, some people think that they'll have a fleet of robo-taxis. ARK Invest thinks they'll have a fleet of robo-taxis. They've thought they'll have a fleet of robo-taxis for many years, but they remain convinced that those robo-taxis are coming someday and will end up being the majority of the firm's value. Again, growth investing is really hard because you have to get these things right. You have to forecast the future. And especially when the market's already pricing in extraordinary positive results, you need to basically have an outcome where you have even more extraordinary results to get a return on what you're paying. So continue to think that Tesla trading at a forward PE of 70 times is awfully rich. But again, if you just have, as we know, asset flows really can override things in the short term. So going back to the point there, that there have been massive flows into Tesla year to date, especially earlier this year. It's been meaningful over the last month, but not as extreme as it was in January, February. In the short run, those are the things that matter, right? If there are more buyers than sellers, fundamentals don't really matter. Eventually, perhaps the market, maybe later this year, is going to recognize that earnings growth isn't really there for some of these technology companies that have been bid up to the moon. But for the time being, it remains pretty elevated. Tesla closed today down a little bit, 256. But again, it's still over an $800 billion market cap for a company that is expected to generate about $12 billion in operating income this year. So, pretty extraordinary multiple that Tesla continues to sport, and we'll see where it goes from here. But just again, people bidding up anything that they think could be perceived as AI, and Tesla seemingly getting that bucket benefit. Okay, next topic was on housing. So there was plenty of housing-related reporting in the journal and across this news media this week on various housing stats. So a huge jump in May. A very much what I've seen many think is likely to end up being an aberration, a 1 month blip for May housing, where housing starts rose 22% month over month. Um, just an extraordinary rate that when you think about underlying interest rates haven't really changed too much, right? 30-year fixed rate is still hovering around that 7% mark. If you look at this bank rate graphic that I'm sharing on my screen, the national average for a 30-year fixed has actually risen a little bit from earlier this year. We're basically back toward where we were before the banking crisis, around 7.1-ish for the average 30-year fixed rate loan. So you've got this confluence of home builders with benefiting from this very tight supply, and supply is further restrained by the inability of many consumers, or the unwillingness of many consumers, to sell their property, because what will they replace the property they're residing with? So it's a little bit of a standoff of sorts between buyers and sellers. While there is still demand at these interest rate levels, and what's been noted is a lot of these home builders are offering temporary buy downs, giving lower rates for the first year or two of the term, with the belief that I think is still entrenched in people's thinking. I, on my personal account, had shared a tweet earlier today, kind of in line with, for those of you who followed along with some of our discussions previously, we talked about, Howard Marks put out that memo about a sea change in interest rates. And there was an investor who I had quote tweeted one of his tweets, taking some language from Oaktree and Marks, talking about how, quote, "We believe the investment environment may be undergoing a dramatic change, not simply a cyclical fluctuation. If the easy money era is truly over, the consequences for investors will be profound. In particular, a starkly different environment will likely produce a new set of outperforming asset classes." So if you're under the notion that we won't be returning imminently to a zero interest rate phenomenon, then a lot of these actions, I think, don't really align with that. So beyond just housing kind of prices and buyers perhaps entering into these buy downs, expecting rates to come down, right? There's been this underlying fervor in the market of assets flowing into these technology companies, which, because you've got long dated interest rates like the 10-year, the 30-year, still pretty low, at least in the context of shorter dated rates. I think they're still attracting a lot of capital just because those rates are still low, right? The 10-year Treasury, what did it close out today? 380. Closed, yeah, 373. So the 10-year Treasury, if we think about where it's been earlier this year, right, or late last year, it got up to 4.2 and change in October, November, when markets troughed. And it's risen over the last month. It sold off after the bank crisis. It had gotten back above 4% before the bank crisis, and it's 3.7 and change. So that 10-year Treasury is actually a massive spread between what mortgage rates are around that 7.1% mark, less that 3.7 10-year Treasury. It's an extraordinarily wide spread going on right now. So all else equal, if rates stayed where they were, you would think that spread would narrow and mortgage rates would naturally come down just by a function of the spread between the 30-year fixed rate mortgages and the 10-year Treasury narrowing over time. But it's extraordinarily wide. And I think that there's the tension there between what happens next with these longer duration bonds. Do investors end up actually selling them off, and do rates rise further? The market doesn't seem to believe that. It still seems to call the Fed's bluff. So yeah, we've got a lot of tension going on, I think, in home builder space, the home buyer space, and yeah, there was also this reporting out I have on my screen about it was out yesterday in the journal talking about a research paper published from the University of Texas that found home prices in zip codes with high PPP fraud. Those prices are about 6% higher than in low fraud zip codes, even in the same county. So there could be further kind of that was a place which fraudsters socked away their ill-gotten gains into the assets, and therefore the home prices, the asset prices, remain further inflated than they otherwise would be. That's at least what the papers show. Quote, the new research says people who receive fraudulent loans were significantly more likely to purchase a home during the program than those who got the money legitimately, ultimately driving up home prices for everyone around them. So that was the conclusion of that paper out this week. Additionally, as I was saying, just the supply of existing homes. National Association of Realtors yesterday reported just over 1 million existing homes on the market. That compares to May 2019, pre-COVID, it was almost double that. So supply is still extraordinarily low. It's really tough for new supply to come out to the market. It's either new build or people selling. And gets back to this, I think until we see more of an uptick in layoffs and unemployment, which maybe we're starting to get there. We're starting to see the uptick in layoffs and initial claims, but we're still not quite there yet. But that would help to ease the extraordinarily tight supply. And we've talked in the past about the extraordinary unaffordability, given that prices remain within 1% or 2% of the all-time highs, and yet rates, right, are, as I was saying, above 7%. So we've still yet to see the housing market kind of reconcile this bubble it finds itself in, because these are two outcomes as I see it. Either rents must rise meaningfully, which in a lot of markets doesn't really seem like it'll align with the underlying economic reality. I don't know that consumers' willingness to pay those rents can be borne, or prices must come down. And I'm more inclined, when you look at the long-term kind of chart of housing, to believe that prices must come down. Now, when and how much, I think we can debate. But yeah, a lot going on in the housing space. Still, certain markets are hotter than others. The South versus the Northeast. We've talked about some of the different geographical headwinds out in California facing from technology layoffs, and obviously Texas and Florida continue to attract a lot of net migration. So very tight housing markets there still. Okay, so let me get through the last two items, and then we can open it up to whatever people want to talk about. You got the Majority Leader Schumer put out a comprehensive plan Wednesday to regulate AI. So with Congress being where it is right now, who knows what, if any, bill ever comes to fruition. He proposed an alternative approach to traditional legislative processes, suggesting the organization of AI insight forums with technology, labor, and critics, rather than doing formal congressional hearings. So who knows? It could just be a whole lot of word vomit out of the Senate, Senate Majority Leader, but we'll see. I think the truth is that you got conflicting feelings about AI. You got some people saying press pause altogether, other people saying we need to have a comprehensive regulatory approach. Obviously, the U.S. compared to Europe has some different rules in place that are going to prevent potentially AI from maybe flourishing to the same extent. So, AI legislation coming down the pike potentially. Keep our eyes peeled for that. And then, lastly, we talked about the container, shipping boom bust. Again, a very much a beneficiary, and now feeling the pain from the bullwhip effect. So this was a story in FreightWaves, who I think is a fantastic resource, whether you decide to pay for their sonar data, which I don't, and while I was at Ryder, found it was very interesting. I don't think you need to actually pay for it. It's a free website. They put out a lot of free data anyways to kind of stay abreast of what's going on at the transport logistics space, both maritime and on highway. But and the point I was making is that you've got a huge decline in prices that charterers are willing to pay. There's just less freight that's being consumed, right? This goods shift. So, this whole shipping space, I won't rehash. I feel like we talked about it last week, so I'll kind of leave it at that. This container shipping downturn is happening. We know that truckload freight remains in a downturn. A lot of people trying to call for a bottom, and some markets might be seeing green shoots, but by and large, it's a continued return to normal, I guess. So, okay, that's all I had for this week's prepared material. Sorry for the delay, for being a little bit all over the place. Elon Musk's technology is not apparently he's not paying the bills, so it doesn't want to work that well for us. But, all right. If anyone in the audience wants to chime in, ask any questions about what we discussed or any other topics, feel free. Otherwise, we could wrap it up quickly this week. One other thing, I didn't mention it, but that I thought was an interesting graphic and bit of data I saw earlier this week. So on my screen is a tweet from Julia Coronado. This is some data from work visas for immigrants. So what's fantastic to see is that there's been we're going back to the labor supply mismatch, right? There's been this ongoing tension where there's just not enough people willing to work, whether they retired early because of asset appreciation, they passed away, they're no longer part of the labor force. They were not there because they wanted to immigrate to the US and they were unable to do so during COVID. Well, the wonderful thing, if you're a fan of solving that labor supply issue, is that work visas being issued to immigrants and non-immigrants are almost double the pre-pandemic levels. Sorry, not almost double. It's 80,000 workers per month above the pandemic lows, 40,000 per month above pre-pandemic. So it's meaningfully above pre-pandemic levels, which of course was under the prior administration, which doesn't like immigrants. So it's great to see this alleviation of some of the labor supply issues by all these new Americans coming into the country. And this should help. I think going back to big picture, the Fed, by and large, is other than being a little slow from the get to changing where they were. Obviously, they were pushed into fast motion by the invasion. And look, I think with where they are now, where all of the kind of the labor market and the different sectors are, I think they should be pretty happy with what they've accomplished. They haven't broken anything per se. I mean, we had the banking issue. We're certainly likely going to see more banks run into trouble, but from a systematic perspective, clearly what happened in March was the systematic problem was staunched by virtue of the action they took with BTFP. But look, it's great to see more people coming into the country to work. Even though we've got this uptick in initial unemployment claims, it's still a pretty humming jobs market. And really, what the Fed would want to see is a loosening of the labor market, but they don't want it to be a horrific recession. They simply want to ensure that labor supply is sufficient, right? They can't really control supply, so it's good for them to see this uptick in supply from immigration. They can reduce demand. They'd rather not reduce demand into a crushing recession. So really, the best scenario for them is that we continue to see labor loosen, unemployment rise slightly, modestly. Uh, you don't get this deluge of pink slips and, as the Psalm rule would say, that we would enter recession once we get 50 basis points above the prior um, unemployment low. So all in all, still moving along. Um, Nothing that seems to be derailing the real economy too meaningfully. I mean, we do continue to see global manufacturing data come in a bit lighter. So that's not just a U.S. issue. Um, yeah, all in all, I think the Fed should be pretty satisfied with where they're sitting. Although it does seem like there is, I would agree with the Fed. All else equal, there's more risk to not hiking enough still than to hiking too much, because they would still rather ensure that inflation is on the right path to their long-term target, rather than allowing it to become entrenched and letting people's expectations of normal rise, and wages continue to rise. And that's something that the UK was calling out this week. And the UK has its own unique problems, but the fact that the UK is an energy importer and energy prices are driving inflation, food prices driving inflation so much, and the UK ministers are like, oh, workers, you need to stop asking, for wage increases, and it's kind of like, really, these people are struggling, facing these inflationary pressures. Their own household P&L is probably taking it on the chin, and then to say, you shouldn't be demanding more, it's tough, because it becomes a negative cycle where workers are demanding more in wages, inflation continues, and get that nasty inverse of a virtuous cycle. So the UK, I think, is going to be the one to really, like, if you want to see what maybe is going wrong, see how that keeps developing, because they're likely going to have to deal with a nasty little recession there, right? The Bank of England did its kind of surprise 50 bip hike this week, and I think it's the right thing, right? They don't have, central banks don't have as many tools as you might think, that they are all omnipotent entities. They can control certain things. They can't control everything. And flipping it back to the state side, right? They can control monetary policy. They can control short-term interest rates. They can try to signal to market participants, if they wanted to send a signal that, hey, by the way, we're going to be, which they've been doing, saying, hey, we're going to keep rates higher for longer. The 2-year yield is finally, over the last month or so, really been taking it more seriously. But they don't control the fiscal purse strings, and you do have a lot of, I don't want to say that the Biden administration put a rock on the accelerator pedal and left it there, but to some extent, in some industries, I mean, they did, right? Inflation Reduction Act, it's a silly name, because it's not going to achieve inflation reduction. It's a industrial policy that basically says, we want you to make all of your batteries in America or in friendly nations to America, and ensure that your supply chain is located in allied or American locales. And there's no cap on a lot of these benefits, so it's very stimulative, and it's going to lead to what we've seen, right? Big time upticks in investment and construction spending. There was a great Wall Street Journal article, not Wall Street Journal, sorry, Bloomberg article. So it was talking about the big loan that Ford got this week. So they got a $9.2 billion loan from the U.S. government, which, again, we're talking about Ford Motor Company. This is a massive organization. So Ford is, the current market cap is $56 billion. So they got a $9 billion loan. So, I mean, it's certainly not immaterial that they've gotten that. And that's just in addition to all of the IRA related things, right? So it's the biggest loan for a U.S. automaker since the 2009 bailouts. It's going to be part of this Blue Oval joint venture that they have with SK, South Korea, on. So it's going to help them achieve their goals of making a lot of EVs. But again, just here's a great graphic. This was a graphic from DOE Loan Programs Office. You can see under Obama administration, a lot of loans were made. Under Trump administration, very few. And then under Biden, now we have a whole lot of conditional loans being made. So it's just a change in kind of this idea of having an industrial policy. But yeah, very fiscally stimulative. All of this spending on battery-related construction investment, chip investment, and once that stuff is there, the Fed doesn't control that. The Fed has no control over how much Congress is willing to appropriate to these programs, and how much the executive branch is willing to, to whatever extent they have control over these programs from DOE, disperse them. Since the Inflation Reduction Act passed, the total amount available for lending through that office is around $400 billion. So we are talking a massive chunk of money. It's not just Ford, but this kind of is something that I think is important to keep it in the background, because it's like, why are we not maybe seeing as much slowing? Because there's still just a ton of fiscal stimulus that's flowing through the real economy, and that the Fed has no ability to control. So yeah, it's 4:40 on a Friday. If anybody who's in the audience wants to come on up and chime in, ask any questions, please feel free. Otherwise, yeah, I'm happy to start my weekend a little earlier, and we can wind this down. And again, if you're following along in that same article, I was referring to just a nice visual of the geographical distribution of these facilities. So as you would expect, they're going to be broadly co-located with existing assembly or plant investment. So a lot of investment in the South, Georgia, South Carolina, Tennessee, and North Carolina as well. And then you've got a lot of investment as well in Michigan, in Indiana, Ohio, where kind of your legacy Midwestern and OEMs have a lot of existing resources. And then, of course, you got a lot of the, whether it's the Japanese or the German or some others that have made big investments in the South. So that's where a lot of these IRA investments are being located, some out in Arizona as well, but broadly in that Midwest and Southern corridor. All right. Well, look, thanks everybody that tuned in. It was a little brief this afternoon, but I don't want to waste people's time. So feel free to check out the replay. Of course, the pinned thread, as well as the link in the our account, has our newsletters, and you can check kind of all the newsletters. And yeah, so thanks, folks, for your interest in Wook Capital Management and our weekly Wook and Review. We'll be back next Friday at 4. We'll also have our book club on Tuesday night at 8 p.m. going over Maupassant's Think Twice. So hope to see some of you there. And that'll be a 2-hour discussion starting at 8 p.m. Eastern. And then next Wednesday, we'll also be back with our market open mic that I host on my personal account at Rod Alsman. And we also have a treat coming up. We haven't finalized the location yet, but we're going to be hosting a panel interview. If you've tuned into some of these, you've heard me mention this company before that had just gotten a joint venture signed. They are a battery recycling startup, and we have the pleasure of hosting their CEO in a panel interview. So whether we do it in the GMEDD Discord or whether we do something on a Twitter Spaces or YouTube, we will communicate that as soon as we get those details hammered out. So looking forward, though, to the conversation with Zarko, the CEO of Recyclical Battery Materials, in about 2 weeks. It's going to be Thursday the 6th. We just haven't settled on the venue yet. So, all right, all that housekeeping out of the way. Thanks again, folks. Hope everybody's doing well out there. Enjoy your weekend, and cheers.